Hey everybody, thanks for joining us on another episode of Investor's Voice. I'm Chad Cesari with the Tokyo Stock Exchange. I am here with Jeanne Stampe. She is the policy advisor at Norges Bank Investment Management. We also have Vegard Torsnes. He is the lead investment stewardship manager at NBIM. And today we're going to be talking about company evaluation and expectations. The first question that I wanted to ask was towards Jeanne. So since we requested Japanese management to be mindful of the stock prices and cost of capital, it's been 3 years. So what do you think has improved the most amongst Japanese companies during this period?
Well, two areas come to mind. First, of course, the capital efficiency awareness. Almost all prime companies have disclosed a plan to strengthen capital efficiency. And your update, hot off the press, of course, shows that the companies with price-to-book ratio below 1 times decreased from about 50% in July 2022 to 27% in March this year. That's a tremendous improvement and very significant progress. So companies are obviously increasing their awareness and taking action. And this also represents a big pool of companies from which good disclosures, good case studies can be obtained. What went well, what went better than expected, or worse than expected, what are the different levers taken. But of course, there's still the 1/4 of companies trading below book value, and so some work remains. And these capital efficiency plans can be improved in their level of ambition and quality of disclosure. So getting over 1 is great, but ideally there is the next step in terms of moving that number to be higher. And the better plans would address, optimal capital structure, time-bound plans, again, to unwind cross-shareholdings, and most critically, what are the investments that are needed to drive that long-term growth and returns? The second area would be board independence. And our voting data shows meaningful improvement in board independence. In Japan, we reduced our votes against directors by 11% in 2025 compared to 2024, and by 34% compared to 2023. So this reflects real change. Fewer companies are presenting boards that fail the basic independence criteria. But continued momentum remains critical. If most of the prime market companies have 1/3 or more independent directors, only 25% have majority independent boards. So the journey towards genuine board independence and objectivity still needs to carry on.
Good to hear that the hard work of companies and investors is paying off in better governance. So it's very encouraging to hear. On the flip side of this, though, what are some of the remaining gaps and what should be prioritized going forward for Japanese companies?
Next frontier for market reform really is board effectiveness. So genuine board capability and oversight. And this is actually critical if the capital efficiency plans are to be enhanced to drive even better results. There's 3 areas of improvement that can be touched on. First is the nomination committee independence. So having CEOs be excluded from the nomination committee for selecting board directors is critical because there is a conflict of interest. The CEO cannot select their own overseers. And this committee should be majority independent with no management present and have published terms of reference to show their approach to skills assessment, diversity considerations, and how they identify and recruit board candidates. The second area would be succession planning. So how boards can disclose their succession planning status, both for directors and senior management. Do they have a forward-looking renewal process? Does the board identify when new skills are needed given the company's strategic direction or changes in said direction? Then third, the transparency on director recruitment. So when a new director is recruited, companies should disclose what specific competence gap was the board addressing, what was the search and assessment process, and how does this director's expertise connect to the company's strategic needs. So all of this contextual information is necessary for investors to assess whether the board is strategically composed and hence can be effective. And all of this can be nicely nested within the human capital development, which is a strategic priority for Japan. And so we very much welcome Japan FSA's February 2026 Human Capital Disclosure Guidance, which shows leadership, right, by connecting the human capital management strategy to business strategy. NBIM's human capital management expectations emphasize that boards should exercise oversight over and also be accountable for human capital management strategy, because companies that invest in human capital are more likely to be successful over the long term. But human capital development should actually extend beyond the workforce to include executive management and board directors. So JFSA's Human Capital Disclosure Guidelines actually provide a useful framework for boards to consider when they are developing succession plans for CEO transitions and also for board renewal. And this actually allows for a holistic and aligned approach for the company from ground up through to the board to maximize the long-term value creation.
This is kind of certainly the hot topic of the moment that we are recording this, but use of cash and other management resources. This is one of the biggest points of discussion at the expert panel for revising the corporate governance code. They're actively deliberating on how to include this into the next revision, but in your view, how should companies think about balancing growth investments and shareholder return?
This is not either or, right? The growth investment and shareholder returns, they are complementary, right? So the companies need to determine, the capital structure, how much cash is needed for operations, for strategic flexibility, for resilience, and then decide how should that excess capital be deployed, right? And the challenge we see is that without the transparent capital allocation frameworks, the capital accumulates without clear purpose. So, for example, progress on unwinding cross-shareholdings has been slowed down over the last 10 years, and these holdings typically earn below the cost of capital. So we'd like to see companies disclosing how they compare expected returns across alternatives, R&D and human capital investments, CapEx for growth, M&A, or returning capital to shareholders. The strong disclosure demonstrates the discipline behind these choices, right? The adequate investments in capabilities that drive competitiveness, investments meeting the return hurdles, and the systematic review of past deployment outcomes. What worked, what underperformed, why? So this learning process leads to better capital allocation over time. And the disclosure should also show the board's role, like how they challenged management's assumptions, what frameworks they use to evaluate opportunities, and critically, their ability to decline investments that don't create value.
Appreciate that. And I think this is a really extremely important message for companies to hear, as I think that some of them may be mistakenly under the impression that the only thing that all investors want are kind of those share buybacks and dividends, but certainly the vast majority of investors that we speak with, they share a similar opinion to what you've just said, and they really emphasize kind of making allocation decisions based on a proper understanding of the balance sheet and what's necessary to generate long-term value. So it's very useful feedback for the companies. In this sense, what kind of disclosure standards or board oversight mechanisms would give the international investors some greater confidence that capital allocation decisions are being made rigorously?
The evidence of robust board oversight mechanisms include, whether the board regularly and systematically reviews the overall capital allocation framework rather than just approving individual transactions. Does the board have the right competencies, including the industry experience, the corporate finance knowledge, to provide that sufficient challenge and oversight of these decisions? Do the directors challenge management's return assumptions, or ask for alternative approaches? Is there a systematic process to review the returns achieved on past capital deployments and compare them to projections? I think critically requiring the board directors, especially the independent directors, to be more accessible to investors for engagement will help deepen our understanding and confidence that the boards are overseeing these capital allocation decisions adequately. And the other area would be the sustainability standards, so the connectivity between sustainability and financial reports. So using the SSBJ sustainability reporting standards can actually help companies to take a more holistic and long-term perspective on capital allocation decisions. For example, climate-related assumptions have direct financial impacts, right? Companies need to account for decarbonization capex. They need to plan adaptation investments to protect revenue-generating assets from physical risks. And they need to consider how climate risk can affect the return on invested capital, whether it's through changes in utilization rates, useful lives, the residual value of fixed assets when they're making these capex decisions. So when GFSA's requirement for the concurrent sustainability information alongside financial statements kicks in after the 2-year relief period, this connectivity will help investors as well to understand whether these capital allocation decisions are realistic and have looked out of the box in terms of looking at different types of risk, right? So if I give you a specific example, if a company discloses some physical climate risks, water scarcity or extreme heat that may affect their facilities, but their capex plans don't include adequate adaptation investments, that's a disconnect, right? And similarly, if the useful life assumptions for carbon-intensive assets ignore transition risks, that signals a problem for us. So these disconnects, again, help us to identify whether there is adequate board oversight and challenge of capital allocation decisions.
I want to turn to Vegard for the next question, which is relating to the points based on investors' perspective document that we had published a couple years ago that highlights the importance of, among other things, aligning management and employee perspectives towards medium to long-term value creation. So there are currently ongoing discussions at the Ministry of Justice about revising the scope of free share awards, for example, under the Companies Act. But from a shareholder perspective, kind of what executive and employee compensation systems do you find desirable, and how do you view the responsibilities of the compensation committee in this context?
Our starting point in this is that we think that the best way of aligning management interest with shareholder interest is for management to become shareholders. We are positive to employee stock holdings as well, but I would like to focus on the management incentives. By giving management stock, they would have personal interest in the stock price just as we have. So we've issued a position paper on what we call CEO remuneration, whereby we think that CEOs and top management should be paid partly in stock, and that stock should be restricted over a long period of time. Our perspective of long period of time is beyond the typical business cycle, somewhere between 5 and 10 years. We see some developments in Japan where management is given stock, but it has to be held until retirement. That may be too long. I think there needs to be some ability to actually capitalize on that stock and sell it, but also being a long-term owner. So we would favor, in short, management to be paid partly in stock, and that stock is held for 5 to 10 years. Now, the alternative to this, and it's what we observe in many other markets, is that stock is given only if the company achieves certain performance targets. The key performance metrics are identified, target levels are set for a multi-year period. Our experience is that becomes very complex. It's very difficult today to set a target for a company 3 years from now. Markets are volatile, the world is volatile, circumstances change, then easily creates misalignment between what is our interest and the best outcome for the stock, and what is the best outcome for management, which is to achieve towards these preset KPIs. So we would like to walk away from that level of complexity, make things simpler, pay management in ordinary stock, hold it for a long period of time, and we think that's the best possible alignment of interest.
You had mentioned that, this is a volatile world and we really can't know what is going to affect companies, what's going to affect their stock prices from here on out. And that's kind of a good segue into the last question that I had for, this is going to be Jeannie's question again. From the beginning of this year in particular, dramatic kind of geopolitical risks and kind of advancements in AI are continuing to kind of disrupt the global business environment. And it's becoming really critical for companies to equip their directors with kind of that appropriate skill set so that they can adapt and persevere in these changing times. So it's against this kind of backdrop that the current proposal for the corporate governance code, they're thinking about elevating disclosure of policies for training and acquiring knowledge in business, finance, and kind of organizational matters by directors to a principal level. So that'll be a comply or explain topic. But as an investor, what does meaningful board capability look like for you?
I think first we need to understand what's the starting point, right? And we need to move beyond those generic skills matrices, right? Where every director seems to tick every box. I mean, those skills matrices, and they create two problems. First, they lack differentiation. So a matrix may show that a director has finance skills, but that doesn't distinguish between basic financial literacy and deep expertise. Has this director managed a corporate restructuring, or led capital allocation at scale, overseen complex financial reporting? The skill level matters a lot for board effectiveness, right? So, but most matrices just tick the box without showing the depth. Then second, even when the company indicates that a director has an expert level skill, the disclosure doesn't show what underpins that investment. So decision useful disclosure provides that expertise behind the assessment. So, for example, not just saying manufacturing experience, but 30 years in automotive production, led factory automation and supply chain transformation across 3 continents. And similarly, not just finance background, but former CFO who managed debt restructuring. So this specificity enables investors to understand the starting point, what's the level of board capabilities, and whether these directors can effectively oversee the company's particular challenges and opportunities. Industry experience is foundational, so a majority of independent board members should have fundamental industry insight, with at least 2 having actually worked in the industry. Each industry has its own drivers of opportunity, risk, and profitability. So without in-depth industry knowledge, the independent directors struggle to form independent opinions on strategy and cannot effectively support or challenge management. So these are areas where it's not training per se, but who you bring onto the board, because you can't train industry experience from scratch as such. But of course, when it comes to actual training and enhancing of the capability over time, the boards need that continuous capability development, not just a one-time training. It should be ongoing. The new directors need that comprehensive induction on company strategy, financial position, risk, industry dynamics, but all directors will need regular updates on emerging issues, be that AI governance, cybersecurity, geopolitical risk, climate risk. And the elevation of director and Kansayaku training to a principal level in the revised corporate governance code is very positive and welcome. But disclosure of training policies must show substance. So we need to see, the actual programs undertaken and content covered rather than just statements of commitment.
So that will wrap up our discussion today. So I would like to thank once again Jeanne Stampe and Vegard Torsnes from Norges Bank Investment Management. We were talking about appraising Japanese companies' progress and what they need to do from here on out. And I think we got some excellent feedback that will be very useful for our companies. So thanks to you both. And we will see you next time on Investor's Voice. Take care.